oil giant Exxon has engaged in preliminary discussions with fracking company Pioneer Natural Resources about a possible acquisition. This is according to a report from the Journal. Now, taking a look at how shares reacted to this news today, Pioneer Resources closing up nearly 6%, Exxon off just about 0.5% today. For more on this, we're going to bring in Jason Gabelman, TD Cowen, Director of Sustainability and Energy Transition. Great to have you here. So just your first thought about this report, this possible acquisition here from Exxon of Pioneer Natural Resources.
Yeah, the reporting seemed a bit light on the details, and this is an M&A story that seems to get rehashed every year. It didn't sound like anything is imminent. The reporting suggested a deal could happen later in the year, but it's unclear at this point. So I'd say really no surprise from a reporting standpoint, something Exxon likely looks at a pretty regular basis among other M&A targets.
Just wondering, in your notes, you're saying historically we've observed that E&Ps, that's exploration and producers, tend to be taken out around a 20% discount to net asset value, which in our measure would equate to $280 per share of Pioneer, roughly a 40% premium to share prices. Pretty steep there. What goes into that calculation, if you could just share that with us?
Yeah, it's just the MPV of the resource. So it's the present value of the resource base of Pioneer. And that's actually a comment from my colleague who also wrote the note, David Deckelbaum, who covers Pioneer here. But when you factor in that potential premium, the deal looks much less accretive to Exxon's near-term multiples than if you price it off of the current value that Pioneer is trading at. And so as M&A gets factored into the stock, the value enhancement to Exxon appears a lot smaller versus where Pioneer is currently trading.
So, Jason, if this deal ends up not coming to fruition, if we don't see Exxon there targeting Pioneer, are there any other potential targets there from Exxon, just given the fact of their interest in Permian Basin?
Yeah, so there's a multitude of Permian operators, as you and others well know. And what Exxon is looking for is something that's of scale in the Permian Basin, that is a large undeveloped resource footprint. There's probably some other players out there that fit those criteria, but it also has to be at the right price, and that's really the trick. The other thing Exxon's noted is that it doesn't want to buy something at the top of the commodity cycle. And at the time of its last earnings calls, it implied that that's kind of where we are right now, where companies that if they're looking to sell are maybe pricing in a higher oil price than what Exxon would price in if it were buying something. So that bid-ask spread also needs to narrow if Exxon, in order for Exxon to consummate some M&A.
Well, we're talking about forecasting oil prices here. Got to talk about OPEC Plus with its big surprise decision just a week or two ago to cut production by 1 million barrels per day. That sparked a short covering rally. So we now see WTI hovering around $80 per barrel, but that could go up, that could go down based on several factors that we've seen here. How do oil companies prepare for this? And isn't that, in fact, why they've been so hesitant to make some big deals over the last few years?
Yeah, what we've seen from oil companies and U.S. E&Ps in particular is investing less in the ground and giving more back to shareholders because those E&P companies did not generate great returns when oil prices were quite volatile in the prior cycle. And the super majors like Exxon have taken a lot of costs out of the business or being more stringent on what they're investing in from a capital allocation standpoint. And it enables them to have more flexibility to return more cash to shareholders and be more nimble in executing M&A when those opportunities present themselves.
Hey, Jason, we're just getting started here with earnings season. What are your expectations for energy? Because, yes, when you take a look inside the XLE, when you take a look at some of these individual names, they have performed okay, given the fact that we're up against a very tough macroeconomic environment.
Yeah, commodity prices are hanging in, and it's not only oil prices that are relatively high, supported by OPEC Plus, as you noted, but also refining margins historically much higher than they've been. Global natural gas prices at much higher levels than they've historically been at. And when you combine the high commodity prices with costs being taken out of the system for these oil companies, and fund flows probably having some upside, just given energy is only 5% of the S&P, half of where it's been in the prior cycle. It does seem like there's a combination of more durable earnings and maybe some fund flow support that could support energy over the next year, and in particular, the global super majors.
We got time for one more. I'll give you the floor. Anything we didn't get to that you might want to talk about inside the oil energy or the oil industry here?
I can mention ESG just for a minute. I think One thing we've seen as a result of the war in Russia is when you take away hydrocarbons from the global energy mix, you end up using a higher emissions energy source. And I think investors are starting to see that and understand it's going to take more time to transition away from oil and gas to new energies. And that could be supportive of equity values for the IOCs vis-a-vis the higher terminal value that you would apply to the stocks. So I think some of the ESG headwinds that we've seen within the energy space are abating somewhat, and that should be supportive of the space as well.